I'm going to speak about insider trading in times of turmoil, and I'm going to focus on particularly one actor at the time, Timothy Geithner. So there's three objectives that I have with this presentation. The first one is I want to give some input on insider trading and why it is worth researching. The second thing then is to show a little bit what I found in my research, which I did over the last year. And the third thing then is to discuss some of the economic and societal implications of the findings that I had. Let me introduce to you the first person that I'm going to speak about. So Stephen Friedman. He is a fairly interesting insider. You might see the smile on his face. The photo was actually, I don't know when this photo was taken, but this person purchased shares in Goldman, and over the time these shares rose significantly by about 60%, which is a fairly substantial return on a fairly substantial share return over less than a year. Where you would expect like maybe 5, maybe 10%, but certainly not 60%. And when people became aware of that, they were immediately press reports about, oh, this is certainly an insider trade, because at the time that he bought these shares, he was both at the at Goldman's board and at the board of the Federal Reserve of New York, which gave him a very interesting insight into what happened at the time. To clarify matters, when I speak of insider trading, I refer to the tradings of corporate insiders, officers and directors in their own firm stock, and that is a perfectly legal thing. It only gets more interesting if they trade on material non-public information, and that is an addition. So you need to have some information on top of the information that you have in your own firm that makes it possibly illegal for you to do insider trading. And the focus of my research is on own firm stock. So that means any other stock that you trade could possibly also be insider trading, but it's not technically part of what I'm speaking about. So most of that is legal, and there's also, even if you have material non-public information, there are certain transactions that are legal, and only a small subset of these transactions that are trading in own firm stock and material non-public are eventually illegal for the purposes of the SEC. And to show where the results come from that I'll be showing you, all of these trades are documented in a database that is held by the US SEC. You need to file, if you're an officer or director of a firm, you need to file transactions in your own stock, and these transactions are made transparent first to the SEC, and after some times to the academic world via Thomson Reuters database that is called 13F database. And all these things are those that happen basically on file. These are documented, and apart from that, there's a certain part of covered trading. That means, for example, trading of shares through different accounts. So for example, there's a very interesting Journal of Finance paper that basically says accounts of minors have excellent trading results, just because, not because the children trade themselves, but parents basically say, okay, why don't you trade this, why don't you trade that? So there's certain covered trading, which is not part of what I'll be speaking about. So focus of my research has been on these trades that possibly could be informed or could be subject to material non-public information, and to basically control these trades as part of a larger sample. Everything else basically forms my control group. So when we speak about insider trading, there's basically three parts that are relevant. So first of all, I try to detect insider trading, and there's basically two criteria that are relevant for detecting potentially informed insider trading. One of them is excess profitability. So you would guess that trades that are very profitable are fairly likely informed, or more likely informed than others are. There are certain behavioral factors in these identifications. So if you trade very large sums, and if you trade on very specific instances, these are indicators that these might be informed trades, as opposed to regular trades that you basically do every month or every quarter just to get you some liquidity or something in that regard. The second thing then is to understand where does the information possibly come from. These trades happen for some reason. If the reason is information, where do these things come from? And generally, most of the insider literature looks at joint board connections. So if you want to show that information might have come from a certain source, you basically look with whom does this person sit jointly on a corporate board. And if these people sit on a corporate board, there's a high likelihood that they have spoken at some time, and that basically gives you an indication, okay, so this information might have come this way, that eventually led to this trade being informed and being profitable. What I particularly do is I look at meetings. I'm in the fortunate position to have the calendar of basically one of the potential sources of information, of non-public information. And by looking at that meeting data, it's much more direct to infer about information possibly being passed on than these board attendance information. But we should always be aware that this private information is not necessarily the return. There might be other reasons. Some reason for that might, for example, be homophily, which is typically argued. So basically what people argue is, I actually didn't get information from someone. It's just that we two are so similar because we went to the same school, we read the same newspaper. That's why we did the same thing, or basically I didn't need the information. I just basically bought the share because, or I bought the same share as someone else who had certain information, just because we are so similar. And the way that I design my research counters that argument. So the way that I select my sample is can counter that argument fairly well. And if you then find potentially illegal insider trading, you of course need to prove. So the SEC then would need to prove that certain information has been passed on and that has actually been illegal, which is fairly difficult because that's why you see not particularly many insider trading litigation or conviction in that regard. So my focus, of course, is on these two. So there's basically no enforcement in here. Let me know, and you might find that the same flag here in this picture has been in the other picture as well, because these are the same photos for the same occasion. We are going to look at the meetings of Timothy Geithner, who at the time was the president of the Federal Reserve Bank of New York. So he has essentially been the one guiding the financial industries of the US through the financial crisis. That makes him a premier source of potential non-material information. One of the only sources that we basically can analyze and for that, we can use his business schedule. So the New York Times in 2009 obtained his entire business calendar based on a Freedom of Information Act request. And they got about 600 pages that looked a little bit like this, in a format that is, of course, not machine readable. So it took me some serious time to actually get this into an Excel file to be machine read and afterwards analyzed. But this is essentially how it looks. Every day, who did Timothy Geithner meet? And based on that information, we basically want to know, given that he's so central in the financial crisis, and given particularly that he designed the Troubled Asset Relief Program, which was essentially the program that the US used, about $700 billion, to buy shares of troubled firms and to buy assets of these firms. It's essentially a premier source of potential information going to the market or going to individual meeting participants. Sure.
Tell us what his career has been like since he left.
So his career essentially after he left, and there's interestingly also a paper what happened in between the two career stages. So after he was the president of the Federal Reserve Bank, he became the Secretary of the Treasury under Obama, and that announcement and the issues with that afterwards also created fairly interesting results on the financial market that have also been researched for potential insider trading, and there's also been findings in that regard. So it's not the only instance where this kind of information is essentially being used by corporate insiders. That's basically the setup, and how have I derived these findings? So I analyzed these meeting data. As I said, I matched that with Thomson Reuters data. That means what I mentioned earlier, every insider trade gets logged by the SEC and needs to be reported. So these two are basically being matched together with some financial data, so particularly return data of the firms, some company data that are essentially company fundamentals, and company event data, resulting in a sample of around 18,700 insider trades that I'm looking at out of about 600 firms. No, about 50 firms with around 600 insiders. And the first thing that is certainly worth noting, and I guess everyone would have expected, but it's clearly visible in the data, is everything that is red, and I guess particularly in the last row, you can only see red, I suppose. Everything that is red is a sales. Everything that is blue is a purchase transaction. So the first thing that happens is that during the time of the sample that I analyzed from late 2016 to early 2009, late 2006 to early 2009, is essentially everyone selling their shares in their own firm. Clearly visible. If you look at the sales volumes, it gets even better. And the second thing that you then say is these sales are generally expected to make, on the long run, so over a 180 or 210 observation window, they're expected to make around 3.1 to 3.5 negative return, just because the people that made these sales are insiders, are as such very educated individuals, very knowledgeable, and in theory they would in normal times make around these percentage as a negative return, because if you sell and make a negative return, it's actually you gaining. In the overall sample of these 18,000 and a bit that I have, it's close to double. So all these people are making much more without knowing Timothy Geithner than they should, in theory. So that's essentially the first finding. So this sales was a very lucrative sales for everyone in the sample. I'm basically now, what I'm going to describe now is after we saw these massive gains in sales, we're going to see how are we going to deep dive into these sales. And there's basically one thing that is fairly easy. One thing is to measure return over market. Return over market is basically just the returns that the stock makes over the return that the market makes. So this is a fairly easy thing, and this is basically the first benchmark that we have. So if you make more than the market, that generally doesn't happen, or should not happen according to general corporate finance theory, at least in the long run. But it occasionally happens. But the market is not the only benchmark that we need to invoke in that regard. There's a second one, and that is basically relates to the homophily argument that I made earlier. What you need is to prove that people actually made more than their direct peers, just because everyone else could argue, well, they have just been in the industry. They knew all that. So they might have just been better informed on general information, not on material, non-public specific information, but just because they were actually the ones reading the Financial Times, knowing what happens at mom and pop somewhere else, were just not understanding what was happening. So to make that argument, to sharpen that argument or to counter that argument, I do basically three comparisons. The first comparison is insiders with a connection to Timothy Geithner versus their direct peers in their firm that they work for. That means if I'm the CEO of Amex and I meet Timothy Geithner, then I'll be getting compared to only my board members. Not to someone else, not to the average investor, but only to these board members that basically get the same information of the same company that I work for. But the only thing that distinguishes us is that I met Timothy Geithner at a certain point, and the others didn't. So that is basically fends off a lot of arguments in terms of what else could there be that explains these higher returns or these different trading characteristics. The second thing then is I compare those that met him. So taking away all the people that are in the same firm but didn't meet him, I compare these people that met him in sample and those that traded after that against those that didn't. So that gives a fair, so that even further reduces the sample, and that basically means everyone who met him had the same chance of doing something. Some people traded, some didn't, and these that traded, we'll see, have higher returns than these who didn't. And what I then do is, out of these people who traded, solely those, have there been certain characteristics that made their trades even more profitable? And there's two things. One of, did they have more meetings with Timothy Geithner, which could possibly mean that they have a better relationship with him, that would make Timothy Geithner more comfortable sharing information with them, or are these meetings are the trade and the meeting more adjacent? In a sense, the closer you are to the meeting, the more recent the information that you might have gotten would still be, and the more valuable it would be, because the market might eventually get this information as well. It might leak, it might, so the more recent that information is, the better it is, the more valuable it is for you as an insider. And to make sure that we don't forget anything, I control for organizational features. All these organizational features, sales, market volume, book to market, pretty much everything that can be found in the literature as to what distinguishes the individual firms and the individual firm characteristics. And I also control whether the firm actually was part of the TARP program or not. So some of the firms in the sample are, some are not. And with that comparison, you basically have a fairly solid basis for arguing that certain trades or certain classes of insider trades were more profitable or different in shape or form than others. And so you can basically infer about information possibly being exchanged. And one of the results that you see is what I call haste in trading. What I mentioned earlier is that information is more valuable the more recent it is. So what you would generally expect is that trades happen, trades are fastened in a way. And you see that very well out of the sample where all the insiders that have at least one insider with a Timothy Geithner connection basically have a trade duration of 16 days. That means within a month there's 16 days between the trades, or there's a maximum of 16 days between the trades, and their average transaction is about $500,000. If you only go to these that have an individual connection to Timothy Geithner, you see that their trade duration goes down to 6 days, and their trade volume goes up to over $1 million. That means they do less trades within the month, and the volume goes up. That basically tells you that they trade more on information. And if you only take these that trade directly after meetings, their duration is essentially 0. That means at least half of them just does one trade within that month, and that is essentially the potentially informed insider trade. And their volume again is higher. And their information is also more specific, but I'll get to that in a minute. To understand the next couple of things, I'll be quickly talking about how does an insider trade look like from a timely perspective. You would generally see someone buying shares, some insider buying shares on an informed basis. For a certain time, pretty much nothing happens. Then the information gets revealed. In this scenario, it's positive information, so the stock price rises. Here, you would generally sell your shares just because the value is reached, so about 50 days, and then afterwards the market returns to his standard level. In my case, I observe pretty much every effect that happens after 120 days. That means pretty much far off what generally prior research has identified. First set of results is, and I'm not going to use this format much more often, but this is the time horizon that we have seen so far. It starts with day 0 and it ends at day 210. And what you see in the first sample that I've given, that is the insiders with a connection versus their direct peers without a connection, is you see a lot of factors positive and only a few negative. What you would expect, since these are sales transactions, is a lot of negative factors. So if you do this initial comparison, and if you stop there, you would basically say, okay, well, there's no indication that these people had better trading returns on their sales, so there might not be informed insider trading. Wrong sign, unfortunately, for most of these time horizons. There's a good explanation for that, and that explanation is litigation avoidance. So what we can infer from that is people choose not to trade, although they might have had access to material information, just because they didn't want to get caught. And they actually they have actually forgone good opportunities to trade, but they choose not to in that particular sample. And if we then drill down along the lines that I suggested earlier, if we then only have a look at the sample that includes people that met with Timothy Geithner but choose to trade or not to trade afterwards, we see a very different picture. So it doesn't really matter which sample for comparison we use, or which particular subsample for comparison we use. We see in a long run the trades of those people that met Timothy Geithner and traded afterwards, 180 days afterwards. They're making between 8 and 22% over their direct peers, over these people that met Timothy Geithner but choose not to trade. And 22% on a long-term basis on a share is certainly out of band, out of what you would generally expect. Interestingly, you could then ask, what kind of information might they have gotten from Timothy Geithner? And one of the theories that you would have is that you get information on the troubled asset relief program at the time. If you then, however, look at the insiders from these firms that also met Timothy Geithner and might have gotten information to that under the assumption that firms that actually were part of TARP would have had the most significant impact on their share price, so this information must have been more valuable to them. You actually don't, I mean, on the regression itself, you see an effect, but if you introduce fixed effects, that effect vanishes. So the conclusion here is it's unlikely that the information that Timothy Geithner passed on was particularly on TARP. It would have also been illegal if it had been on TARP. So the theory that I currently pursue in that regard is that he actually gave market participants a fairly reliable macro outlook, which would be consistent with him not giving out information that would have been illegal, and it would be consistent with these very long timelines that it takes for these returns to be actually realized, because everything else in between these 0 and 120 days is essentially noise that is difficult to interpret.
Can you explain fixed effects?
Sure. So fixed effects essentially. So I mean, everything in that regard is essentially a fairly standard regression. So there's basically, of all these things, there's basically a dummy variable that says, has this person spoke to Timothy Geithner or not? Has this person traded after meeting Timothy Geithner, and over what time horizon? And fixed effects essentially introduces both time and firm as predictive variables in these regressions, and that. I mean, for time, that's fairly clear. So if you would have, for example, some time effect by, say, inflation, you would generally see with a time fixed effect this basically being taken out of the equation. If you would have a firm fixed effect, that would be more difficult. But say, for example, this effect would only be applicable in a certain industry. So we only have financial industry here. But say this effect would only be applicable to banks as opposed to investment managers or credit card firms or whatever. So with these fixed effects, you would basically see, okay, well, there's there's some other explanation. So it's just an additional regressor. And with these fixed effects, you actually arrive at the conclusion, okay, well, this the finding for top firms is essentially it's not consistent. So you would generally, it would generally not help you to validate your hypotheses in that regard. And
So there's still a trend in that in the final.
yes, this
On the right, with fixed effect.
yes, but you would generally go for negative sign here.
Okay,
So the large 17.2 here on a 120-day basis is certainly difficult to explain, because you would expect a negative value, even if it would only be slightly negative as it is here. And this 0.1 here is not significant, so you could take that away. But this is 17.2, highly significant to the power of whatnot. So that's difficult to explain, and it doesn't help you validate, unfortunately. I would have really liked this thing to be also true, but apparently reality is in this case not as hypothesized. And then a third interesting aspect in that regard is the question: what actually contributes to? I mean, we've seen that these results are fortunate for these people that trade, but the question is, what is actually the reason, or what contributes to these things? And there's basically two variables that I looked at. One is the number of meetings. So the more you meet Timothy Geithner, the more likely he's going to give you something, just because he knows you better, you have a better relationship, and since these things are valuable, you would generally expect that people get it if they meet him more. And then there's the meeting difference. That means how long is the trade actually away from the meeting with Timothy Geithner. And the statistical effects here are fairly clear. They are negative, as they should be. Here, since the less is better, the effect must be positive, so that's also fairly okay. If you look at the statistical effect, you would basically say, okay, well, this appears more valuable. It's not, because the weighting, so the number of meetings that you generally have is somewhere between 1 and 6. So so if you're good, you have 6 meetings. If the meeting difference is somewhere between 1 and 180, with an average of around 65. So if you have a look at the economic effect, you actually see that the meeting distance explains a lot of these negative returns, which you go for. Whereas the number of meeting has a contributing factor, but it's not as important as the meeting distance. And that means it's good to know Timothy Geithner, but it's actually important to trade after meetings with him. You want that to be fairly speedy if you want to realize these returns. I'm not saying you should, because it might still be illegal depending on what information you get. But if you want to optimize that, go for it. Go for directly trading after meeting him, and generally get on his schedule. It's lucrative.
I thought you saw a slightly different trend in the previous slide. So the final plot you have here,
Yeah.
where you have your minimum at 150 days.
Yeah.
In the previous slide, you had the final 210 days is the most negative.
Yes, that is because we're using different samples here. So in this one, this is the full sample of people who trade after meetings and those who trade not necessarily. In this sample, we can only use those who trade. So that is another subsample where we see an effect that is directionally the same as we saw before, but doesn't stack up fully in terms of numbers. Just because here you would have a hard time calculating the meeting difference between a meeting and a trade that didn't happen. So that's basically the point. There's 3 considerations around that to take away. One is market efficiency. the fact that it takes 200 days for these differences to be impounded in a share price is by itself a fairly strong violation of the principle of efficient capital markets. The question why that is tricky to answer, and there's of course other phenomena that take into question at least the strong efficiency, strong form efficiency of the capital markets. But given that this is such a tenet of such a fundamental pillar of corporate finance, it's certainly worth thinking, why does that happen? And one of the reasons that I gave that might be applicable is the long-term outlook that I hypothesize Timothy Geithner gave people, as opposed to very, very specific details on TARP. There's also an additional argument to be made that basically says, well, it's a time of weak policy or of high discretion in policy. So just because the capital market wasn't functioning appropriately, these things might have lasted longer in the financial crisis. Yet I think 200 days would still be too long. I mean, that's essentially a year in trading days. The second thing then is economic relevance. The people that do these trades, and we have seen that that the volumes of these trades on average are around 1 million. Even if you realize these high returns, that doesn't, in absolute terms, doesn't make you quite rich, particularly if you get compensation as a CEO, for example. I mean, you get multi-million dollars, and then you basically do these transactions, which do not really add to your wealth, to your absolute wealth, and pose this high legal risk. And there's something that needs to be reconciled. This is a discussion that has been ongoing in the literature for quite some time. There must be behavioral reasons for that. So people assess their compensation relative to their peers. That means even if they get multi-million salaries, they still want to get these 60,000 out of that trade just because it makes them more wealthy than their counterparts in their own board, which is kind of bizarre, but lucky us, because the trades of insiders are generally one form of the market being efficient, because if insiders trade, others see it, mimic it, trade in the same way, and that in the end gives the information away to the market. So whilst they're trading on subpar motives, it's still good for the entire market. Although, and that's essentially the last point, if you sum these things up, you have, give or take, 25% of excess returns on the market, which can be seen as a form of compensation to the individual insider trading and revealing that information to the market. The question is this revealing of information to the market really worth 25% on an individual stock return in under a year? And if you feel that it's not, you need to tighten regulation. So you need to monitor these things more, you need to see more where the information comes from, and well, you need to get your regulation in order. That concludes my talk. This is a summary of key takeaways. Not everything is illegal. It's profitable to know Timothy Geithner. TARP hasn't been so much of an explanatory value, and basically this has been the financial crisis. There has been large policy discretion, which might or might not be the reason for these findings. Given the current status in the US, I would guess that this policy discretion will happen again sometime soon. So stay tuned whether you can still make 25% on your insider tradings. With that, thank you very much for your kind attendance, and I'm very happy to take on questions.